Good afternoon, everyone. Thank you so much for joining today. We're here with Miss Ruth King for our normally once a month podcast on everything financial. I see another Ruth King joining.
I have no idea.
I
Don't worry
don't know
about it. Let's
yet.
just
All
go.
right, well, let's rock and roll. So, financial crisis, how do we know we're headed that way?
Yep. So anyway, it's great to be back and here again. So let me share my screen and let's make sure I can share it. All right, you should be able to see my screen now, and I will start. Come on, there we go. All right, so today, what's really interesting is most of us, quite frankly, have our heads in the sand when it comes to our businesses and our financial statements. And there are really three subtle signs that might be headed for a cash flow crisis. And if you start paying attention, you can do things to avoid it. And the last thing you want to do is to run out of money. I mean, if you run your business only by looking at your checking account, you're kidding yourself. You have a really good chance of running yourself out of business. And that's not what we all want to do. We start our businesses for a reason, and we got to be profitable to make sure that we can get the cash flow that we need so that we can stay in business. So do not use your checkbook to run your business, because cash is not profit. Profit is revenues minus expenses. So if you earned a profit that month, that means your revenues were higher than your expenses. And there are two types of expenses. There are direct or cost of goods sold expenses, and there are overhead expenses. So revenue minus expenses is a plus. That means you were profitable that month. If your expenses were greater than revenue in a month, that means you were not profitable that month. That has absolutely zero to do with how much cash you have in the bank. You can have an unprofitable month and have a lot of cash in the bank. You could be incredibly profitable and be running out of cash. So do not assume cash is profit. It is not profit. Cash is a balance sheet item. Profit is a P&L item. Two are totally different and separate spreadsheets. Okay. So what we're going to do today is we're going to learn which is most important, cash flow, or profit. And then I'm going to give you the three subtle signs of an impending cash flow issue so that you can watch them, take care of them, and you won't go, oh, we don't have enough money for payroll. Not a good idea. Definitely not a good idea. So for those of you, this is the first time that you're on, welcome. My goal is to have a profound positive impact on your business and other people's businesses by giving you the tools to get and stay profitable, build wealth, and quite frankly, give back. That's always been part of my mantra, share the wealth. It's really important to do. I have spoken all over the place since about 1987. And for most of the major manufacturers, most of the distributors, and pretty much had fun going across the US and Canada and Mexico and even to the UK. So it's been an interesting year last year. So my goal is still educate, all right? These are the 6 books that I've written, and they're all available on Amazon. They are all on Audible. The 101 Dumb Financial Mistakes, I found out today, is being translated into Chinese. So that's going to be really interesting with Chinese characters all over the front of the book. So I was really excited about that. So we'll see how that goes. And it should be out in about 18 months. Okay. So my first question to you is, which is most important, cash flow, or profit? Think of an answer, right? And I'm going to explain to you what the right answer is. Most of you probably said cash flow, and you're not right. Okay, so here's the story. All right, let's assume that this is a tank of cash, dollars, cents, rather than a tank of water. At the top of the tank, we have cash coming in. We open the spigot at the top. The level of cash in the tank rises until the end of the month, and we close the spigot, and then we have to open the drain to pay our bills. So if cash were most important, you'd never have anything coming in at the top. You wouldn't care. So you'd open the drain at the bottom and you'd drain out the cash little by little by little by little by little. And then all of a sudden you don't have any cash left, maybe a penny, and you're out of business. All right. So yes, cash pays the bills, but cash is not the most important. All right. Most people say cash flow. All right. And let me tell you a story. And I'll tell you, this tells you why cash flow is not the most important. So two guys, shouldn't say that, two contractors start a business together and they grow their business from zero to about $2 million in 12 years. And this is back in the 90s. So $2 million was a lot of money back then. And they never looked at their P&L and their balance sheet. What did they do? They looked at their business through their checkbook. So if they had money to take their discounts and money to pay payroll and money to do whatever they wanted, terrific, they were in good shape. And so the business grew. And the cash flow went up, and obviously cash went out, but the level of the tank was still there. Well, when they stopped growing, they started having cash flow problems. All of a sudden, every once in a while they couldn't take their discounts. They had problems paying payroll, and they're like, wait a minute, we're a $2 million company. We've never had this problem before. Something's wrong. All right. So they were smart enough to call me. And it turns out they were losing a nickel for every dollar they took in the door for 12 years. And you're saying, how can that be? Well, as you are growing, cash flow continues to increase, but it was increasing 5% less every single month than it should have been. So what happened was the money from one job started the next one. And as long as the number of jobs were increasing, as long as the service revenues were increasing, you never saw a decrease in cash. Where you start seeing the decrease in cash is when you literally stop growing, which is what happened to them. And that tank is decreasing by 5% every single month.
Turn and burn.
So cash is important. Yes. You got to have it to pay the bills. Cash flow is important. Yes. But really what you need is profitable cash flow. All right. So if you since they didn't have a profitable business, what was happening is every single month, the tank was rising 5% less than it should have been. And it was masked because they had increasing business and increasing jobs and increasing maintenance and increasing service and all that stuff. As soon as it stops growing, you're in deep trouble. All right. And very slowly, they started having problems. So cash flow is important. But what is really most important is profits, because the profits turn into positive cash flow, which turns into cash. So most important is profitable work, collecting for profitable work, which gives you positive cash flow, which gives you the cash you need to do what you want. All right. So it's positive cash flow. You can have cash flow, but if it's negative cash flow, you're still going to go down. All right. And we're going to show you, and I will show you in the subtle things where that really comes into play as we get through this session. All right. All right. So I'm going to give you the warning signs. Number one, decreasing current ratio. And this is the sign that you're becoming less profitable, which means that collecting on that less profitable work means that you are having less positive cash flow. To define it, it's current assets divided by current liabilities. Current assets are things that are that are either cash or turned into cash within a year. Basically, cash, accounts receivable, inventory, and prepaid expenses. A prepaid expense is like your insurance payments due once a year. You take a 12th of it every single month, and the other 11 months or 10 months, whatever's left, is in prepaid expenses. Current liabilities are things that have to be paid within a year. So it has to be greater than 1. And if the ratio is decreasing, find out why your business is becoming less profitable and you're having less positive cash flow as a result. All right. So you always, in most of the case, want your current ratio to be increasing rather than decreasing. Okay. So this is what it looks like on a monthly basis for one of my clients. And you can tell it looks like an EKG or an EEG or something like that. It means absolutely nothing. You can't tell what's going on here. Current asset is the blue line, or current ratio is the blue line. Your asset test, which is your current ratio minus your inventory, divided by current liabilities, and then receivables to payables is the bottom line. These are what are known as your liquidity ratios. But on a trailing basis is where you can really tell what's going on. And trailing basis means like the number for the data point for December 18 for current ratio is January through December 18, add them together, divide by 12. So we've got an entire year's worth of data divided by 12, taken a point at a time. February of 19 is March of 18 through February 19, add those 12 months together, divide by 12. That's the February point. So we get rid of all 5-week payrolls, we get rid of all seasonality. What is the business really doing? And you can tell by looking at this that this company is headed for a problem because their current ratio is decreasing, right? Something's going on. They're much less profitable than they were. And there's lots of reasons for it. One of which is our prices have gone higher. All of our supplier prices have gone higher. Did you raise your prices enough to be able to handle that? I was doing a presentation for Johnstone Supply in California, and average supplier increases, not 23, 22, I think, were like 30 some odd percent, and the average contractor raised their prices 28%. You're losing money, all right? So you got to make sure that this is not happening, all right? All right, so this is what we want to see for good current ratio graphs. And you can see that it was going down and we're continuing to go up, and the trend is headed the right way. The other thing that you noticed about this between current ratio and asset test is that the current ratio and the asset test are parallel. That means you're keeping your inventory levels appropriate. That means that you're not adding too much inventory, you're not using much inventory, it's staying consistent. So if we look at this one, you'll notice that there's a spread between the current ratio and the asset test, which means that they're buying inventory too. So not only are they becoming less profitable, they've got more inventory than they've had in the past. Not a good thing for cash flow. Okay. All right. So here's where I want you to look. I want you to look at the profitability of jobs, and I want you to look at job costs. What are you doing with respect to jobs? And not only to the gross margin level, I want you to job costs all the way down to the net profit per hour level. All right. We've talked about net profit per hour in previous sessions, so I'm not going to repeat it here. If you want a job cost template, let me know. I'm happy to send it to you. Okay. Now, the other 2 and 3, have your costs increased and you haven't raised your prices, or has your productivity decreased? One of those 2 things is probably happening. All right. Productivity decreased means that a guy charges you for 40 hours and he's productive only 30, or he's productive next week 28, or something like that. Your productivity is decreasing, right? You want the guys as billable as you possibly can get them. And you want to make sure your productivity stays up or increases. Okay. If your costs have increased and you haven't raised your prices, that is step 1. Raise your prices. Everybody else has to, or else they're going to go out of business. And I would prefer it not be you all. Okay. All right. Warning sign number 2, increasing receivable days. Now, this is the number of days from the time you send that invoice to the time you get paid on average. If you are mainly COD, this is probably 10 to 20 days. Okay. So if you are mainly COD and you're normally at 15 days, which is great, simply because it's less than 30 days. But if it's creeping up to 16 to 17 to 18 to 19 and 20, and all of a sudden it's taking you an extra week to get your money, why? This should be a warning sign that it's going in the back of your head that something's not right. All right. For those of you who are COD companies, your receivables plus cash are really, really, really important. And it should be greater than 1 and maybe greater than 2, depending upon your mix of business and things along those lines. But that's what you should be seeing. All right. All right. So let's take a look at it. this is the receivables to payables ratio. And you can see the green line, which is there. And you can also see the current ratio and asset test are decreasing on a monthly basis, which is not good. We found out that you're becoming less profitable and not exactly a good idea. So you're noticing your receivables to payables ratio going up, which means that your receivable days are going to go up. And then your current ratio to asset test is actually going up on a long-term basis. But if you look at the monthly basis is where you should be looking, it's heading downwards. So in this case, looking only at trailing data tells you a very different story than what's happening on a monthly basis, which is where you really have to pay attention here. It's going down. Your profitability is decreasing. Your receivable days are increasing. We have some issues, okay? Here's a good one, just like the last time, it's the solution. This is where you want to be. All right, so here are 3 places to look. The ratio is increasing. Is it taking longer to bill? So for example, if you're commercial and you used to bill every day, and now you're billing every 3 to 4 days, this is going to make this number to go up. And then if you're commercial also, our customers taking longer to pay you. The only other thing it might be is, did you send out huge invoices? So for example, if you closed out a major job, and this has to do mainly with large new construction jobs, like $500,000, $1 million jobs, the last payment will affect your receivable days because you have this huge revenue and receivable, and not necessarily it's not being paid yet. So that's about the only thing that if you sent out a huge new construction final bill, that you could say your receivables are increasing. Okay. All right, warning sign and number 3, decreasing asset test. And remember, asset test is current assets minus inventory divided by current liabilities. So bankers in their infinite wisdom, and I use that in quotes, and hopefully none of you are bankers on here, say that we, as a industry, keep too much money tied up in inventory. Well, they haven't looked at our financial statements lately because most contractors don't even put inventory on their balance sheets, which is a mistake. And I'll tell you why. All right. I know this is not what part of this particular webinar, but think about it this way. If you have $200,000 of inventory in your shop, or even $100,000, and you're going to sell your business, nobody's going to tell you to put the inventory on your balance sheet and increase your net profit by the 100,000 or the 200,000. And most businesses are now multiples of somewhere between 4 and 6, and let's assume it's 5. Makes it easy. So if you have $100,000 in inventory, which is now in cost of goods sold, which means that your profitability is $100,000 less, that means you're going to get $500,000 less for your business than you should be getting. This is why you put inventory on your balance sheet. Say, well, I'm not selling my business. Well, guess what? Then your ratios will be wrong because your profitability will be less than it really and truly is, and you're going to be making decisions on unrealistic numbers. So anyway, that's why we have inventory on our balance sheets. So as I showed you in that graph, it needs to be parallel to the current ratio, which means that your usage of inventory is doing well. And if the ratio is decreasing, find out why your business is becoming less profitable, i.e. like your current ratio, or you're adding inventory. So one of those 3 things is really and truly going on. All right, so just be careful because they are subtle. Here's an example. We showed you this before. The lines between current ratio and asset test are increasing. We're definitely becoming less profitable, but we're also adding inventory at the same time, which is not exactly what we want to do. Okay. All right, and here's the good one. Again, we're looking at a parallel line between current ratio and asset test, and our receivables to payables are doing just fine. All right, So those are the three warning signs that you may be headed for a cash crisis. And you're not going to see it. I mean, if you just look at your P&L and your balance sheet every single month, you'll never see it. You have to graph the results. And graphing the results is the only way to really see what the trends are in your business and what's going on in your business. So make sure that you're not buying too much inventory, that if you have a stocking order, then it should expand and contract as you use the stocking order. Unfortunately, people steal from you too, and this could be a reason that you're buying more inventory. And if your fund is going down, here's my fourth question to you. Can you just not buy anything? Can you say, we're using what's on our trucks, we're using what's in our shops, unless it absolutely has to be bought for a job?
Right. Buy it as you need it. Down and dirty.
All right. So where are your financial statements? Because you're not going to be able to do any of this stuff without knowing where you are. Okay. So you can do nothing, stick your head in the sand. Or they're inaccurate and you need help cleaning them up. That's fine. Or you think you're accurate but aren't sure what the statements are telling you, or they're accurate and you're ready to take the financial control of your company. 2 and 3 are kind of together. If they're inaccurate, I can give you people, we do not clean up books. That's not our thing. Work with some really good CPAs and bookkeepers who understand our industry, and they can clean up our books or your books for you. So in the research that we've done, 75% of all businesses, not only contracting businesses, but all businesses are not accurate. And I verified that with a few CPAs, and they've told me it's higher. They think it's more like 90%. Can you believe it?
No.
Yeah.
That's nuts.
I see it every day. It's crazy.
Yeah.
But you don't care, because you don't look at these warning signs, and the next thing you know is you can't make payroll. And that's not where we want to go. So
I have to say, personally, prior to hiring a CFO, a full in-house bookkeeping team, I'm probably that one with the head in the sand. I think the first thing that our CFO and our bookkeeping and new tax team, when they all came in, said was, here's all the business you're no longer going to do. And as many excuses as I had to why and all the rationale in my heart, strings are pulled. It was the first thing they cut is, you might as well give them some money, give them $100 each, buy them a new pair of shoes to go knock on some doors, but don't take them on as a client because you're losing money on every one of them. I fall into this. I mean, at some point, I lived in that space for quite a long time.
Yeah. You know, and when you start job costing and you see the unprofitable work, you stop doing unprofitable work.
Yeah, I mean, that it took us putting time tracking on every single human being's activity in our company and understanding exactly how many minutes, how many hours, how many days, how many weeks every activity took. But I feel like in the first probably 10 years of running my business, I felt like I had spidey senses.
Yeah.
That's how I did it. So I get it. I mean, this is everything.
It was really funny because I interviewed somebody who's potentially going to take over the service side of a company that I'm working for. And she had about a 3-hour conversation with the owner last Friday. And she said, I was impressed. He knows what his overhead numbers are. He knows what his net profit numbers are. Most businesses don't.
Yeah, I would
Well, if you work with me, guess what? You're going to know those.
Right? You will.
Yeah, because you want to. Yeah. So if you need referrals to bookkeepers and CPAs who can help you, let me know. I'm happy to help you do that. It's the first step to not being part of the 75%. And then there's my email address if you'd like, one of many, but that will get to me too. Okay. All right, so let's say they're accurate. Congratulations, you're part of the 25%. Yay. So if you want a better understanding and looking at the graphs and looking at the ratios to make sure that you don't get into a cash flow crunch without, hitting you upside the head, you can do 7 steps to a financially fit business. And then there's a boot camp for smaller contractors. if you need that thing first, and you'd have to understand pricing and all that sort of fun stuff, one of those two classes, they're all online, can help you. And then if you can also do www.financiallyfitbusiness, which is the software that we use to actually do the graphing. It takes you less than 10 minutes a month. And starting on Friday, you're going to be able to upload your financial statements if you're QuickBooks based. We're working on the other. AI is going to read it. And then if they're right or they look accurate, you still can choose to analyze them if they're not exactly right. That's totally up to you. We don't, garbage in is garbage out, but the garbage you might feel is not appropriate, that's up to you. We're not making that decision for you. So if there's the QR code to do that, if you'd like to do that, but basically don't be one of the 75%, because you will have a situation one day where you're just going to run out of cash. Jen, you were smart enough after 10 years to allow people to help you run the financial side and make you put your big girl pants on.
You are not lying about that. I feel like the two biggest decision was bringing on a full actual HR team and the financial team. Understanding the people and the finances, it's completely different than being a subject matter expert at whatever you're skilled at.
Totally. Totally different. All right, so here's the three. Make sure that your current ratio is increasing. Your acid test is parallel to your current ratio. That the acid test is not spreading, the difference between current net ratio and acid test is increasing, and make sure that your receivable days is consistent or decreasing. Okay. Those are the three things. If they're going the wrong way, you need to find out why before you get hit between the eyes with the baseball bat and go, we're running out of cash. All right, that's not where you want to be. Okay. All right, so questions.
So you guys, if you have any questions, feel free to drop them into the chat on your control panel on Zoom. I don't have any yet. However, I am curious on the marketing side, how critical do you believe that calculating return on ad spend and return on investment is, and how it relates to this? I mean, it's something we put a lot of time and energy and money into over the last year, is making sure that we can track every dollar invested and what kind of return we're getting on those in dollars, where are the gaps in processes, whether we're not answering phones, whether we're not returning leads from forms, whatever, everything. Do you notice that the majority of the cash flow problems are coming just from these items on there, or would you agree that improper marketing investments are part of that?
Actually, improper, everything is part of it. Improper pricing, improper marketing. I mean, we did a webinar, last year sometime, about Ruth's rules. Yeah, I think we did it last June or July, and it basically said if you are spending X number of dollars on marketing and your gross margin is 40%. So let's say you're spending 10,000 on marketing and your gross margin is 40%. Then you have to take the 10,000 divided by 40%, and that's 25,000, and that's your break-even revenue that you have to generate to pay for the 10 grand. Are you doing it or not? It's black and white. There's not a shade of gray. Right. And if you're not, CI Web Group's not doing their job.
Or 100%. I mean, this is why we commit to, this is why I love having Ruth on these webinars, is it's absolutely freaking pointless to invest in marketing and advertising if you're losing money on every job you're doing. All additional marketing and advertising is doing is driving you into the ground faster. So it's just a critical pivot point for every entrepreneur who's tried to operate their business with spidey senses, pretending like it's okay with the limited visibility that we have. And, this is not where we cross our fingers and pray to God to make sure that we're going to get this right. This requires data analysis and talent and experience outside of our technical expertise, regardless of what industry we're in. If we're in trades industry, our own company, and so forth. So I want to make sure that, as you guys see these webinars getting posted on LinkedIn, register, keep feeding your mind. Ruth talks fast. She's a freaking subject matter expert. I hear it. I'm still processing stuff she said on slide 2 and 3. I get it. I get it.
Sorry about that.
No, I love it, but don't be afraid of new content and information and something that's not your wheelhouse. We all have something that's in our wheelhouse, but we got to get comfortable being uncomfortable, and we've got to learn this. And the only way to do that is show up, suit up, and participate. Every time you see one of these webinars, make time, put it on your calendar, at least register so you get the recording of the webinar. The more you listen, the more things are going to start connecting. It's like having 100 tiny circles that nothing's connecting. Attend enough of these, you're going to get two bubbles that connect, and you're going to have an aha moment that makes a huge difference in your business. So, Ruth, as always, I thank you so much for taking time out of your busy schedule. I know you're slammed, and thanks to everybody who registered for today's session. Take action.
Wait, we have
There's
a
no
question.
hands. Oh, what do we got? Let me see.
Yeah.
Oh, no, it's an AI chat.
Oh, okay.
It's an AI chat. So,
Because I see a question in the Q&A.
oh, let me see here. Hang on a second. So Martin wants the job costing template. Reach out to Ruth. Martin, do you need, if you need Ruth's email again, you want to put your email address back up?
How's that?
There you go. So this is Ruth's contact info. Definitely shoot her a message and get that job costing template. And Martin, thank you again for A, the question, B, for showing up and participating. We appreciate you. Good stuff. He says thank you.
Wait, one more question.
It's Martin saying thank you.
All right, you're welcome. I look forward to sending you the template.
All right. Thanks, you guys. Appreciate it. We will see you again on the next one. You can get more information on our LinkedIn account. Just go there. You'll be able to see them as they come out. Get registered. Reach out if you have any questions. We appreciate you very much. Have a great one.